Welcome to the Investing Show, where we discuss the news that matters to investors and get ideas to help you make more of your money. I'm Simon Lambert of This Is Money. Joining me in the studio, I've got Richard Hunter of Wilson King Investment Management, Richard, and Nick Batsford, Tip TV.
Simon.
Coming up later on today's show, we're going to be talking gold with Adrian Ash of BullionVault and what's happening with the yellow metal. But first, we're going to have a quick look at the news over the last fortnight or so. And it's been fairly busy. The two things on many investors' minds, Donald Trump and Brexit, have got a bit more real. We've had Trump's inauguration in the US with some particularly bullish statements, or typically bullish statements on his part, I should say, about America first, and also his staffers coining the phrase alternative facts, which I think we can expect to become one of the buzzwords of the year. Over here, we've had Theresa May laying out her plan for Brexit, which she was accused a little bit more of trying to have her cake and eat it, but actually at least it did lay out some form of framework and also set a clear marker to our colleagues over in Europe to say, please, let's make this sensible, grown up and not punitive. We've got inflation up to 1.6% in the official numbers, and retail sales down, surprisingly, despite the fact that some retailers appear to have actually been doing very well, a bit more of which we're going to look at later. But first, a quick look at some of the things that have been happening on the markets with Richard Hunter. Richard, the big thing for investors, I guess, in the UK was that our winning streak finally came to an end, didn't it? After a record run of consecutive closing highs and a record run of daily highs, it stopped. What happened?
Yeah, and to the extent the FTSE 100, even though we're only in January, is now flat for the year after that pretty good start. I think you need to go back to President Trump, as you mentioned. Sometimes, as we know, it's better to travel than to arrive. And certainly in terms of the American market, that's roughly what's been happening there. And since his inauguration speech, he's been a bit light on detail in terms of what tax cuts might be coming, lighter touch regulation for the banks, infrastructure spending, etc., etc. So what you've actually seen, what he has been very clear about, of course, is the potential for border taxes, trade wars, protectionism, etc., which, whilst it should be no surprise to American investors, has nonetheless meant that the US indices have come slightly off the boil, because there's an element of disappointment, although obviously he won't be judged more fully until his first 100 days. As a result of that, of course, there's been a little bit of weakness in the US dollar, and the currency market being what it is, a zero-sum game, that has actually made sterling slightly stronger. And as we saw almost point for point last year, it's now got that inverse relationship with the FTSE 100. So as sterling has strengthened, so the FTSE 100 has also somewhat come off the boil.
It's like playing a pinball machine, isn't it? It's the pound bounces backwards and forwards, down the alley, depending upon what's been said about Brexit or what's happening over in the States. This scenario where we've seen the FTSE rise as the pound has fallen against the dollar, and that's very much been the trade for investors going back, 3, 4, 5 months or longer. Will that stop, do you think, or do you think it will has some time to continue?
I think the issue is that one of the reasons you would have noticed it less over the last few years is that sterling was fairly stable, and it's certainly been anything but stable since June the 23rd. So it really now depends from January on whether we are now in some kind of range. And if sterling stays fairly stable, so should the FTSE 100. In fact, if you strip out sterling from 2016, it was actually quite a pedestrian year, which in a lot of ways means that the market can't really be argued as being overvalued. But quite apart from the two big themes of Trump and Brexit, which will continue to be themes as they unravel as we go through the year, on the shorter term horizon, of course, we're now getting the fourth quarter earnings figures coming through thick and fast on both sides of the pond. You've already mentioned the retailers. We'll probably have the banks next month as well, I should imagine. So in terms of any momentum we had, it's now going to be as important as anything else that those companies keep their part of the bargain and show that the trading momentum has continued to be strong.
And looking down below the FTSE, obviously a lot of the attention has been on the FTSE 100, hasn't it? But if we look at the FTSE 250, looking at the mid-cap companies and companies, doing business around that space, How are they reacting to the whole Brexit scenario?
Well, as a general rule of thumb, the FTSE 250 is often described as being a barometer on the UK economy. So that's where you can certainly expect some more volatility. It's certainly more UK-centric than the FTSE 100. It certainly is more representative. So it's as a good an idea when you're hearing that the market's fairly volatile at the moment, particularly when we actually get some meat on the bones in terms of Brexit negotiations, for example, to keep just as close an eye on that particular index, if you're invested there, of course, as the 100 itself.
And I think one of the interesting things that we've certainly looked at over the past couple of weeks with the FTSE hitting all those highs is we've looked at the valuation on there, and I mean, if you look at the price to earnings ratio on the FTSE 100, it's sky high at the moment. It's over 30, but that's backward looking. That looks historically, and that's to do with some very bad earnings announcements from some companies last year. If you look to the forward PE, again, that's a little bit, finger in the air kind of thing, because that's based on analysts' forecasts, and those analysts might be wrong. But that obviously brings it much more down to a sort of fair value kind of level. The dividend yield, I think, seems to indicate that, round about fair value as well. And if you also look at the cyclically adjusted price to earnings ratio, it looks to be around about that fair value. And obviously that means that you're not investing in a market that's cheap, but it does at least give you a bit of headroom for some gains, doesn't it?
Well, it absolutely does. And once you start digging a bit deeper and looking under the bonnet, as you've just described there, that's a perfectly good example of why you can almost not disregard, but put some distance between yourself and the headlines that FTSE hits new all-time high of 7,150 or whatever it is. Quite apart from the fact the constituents of the FTSE couldn't be more different to what they were in 1999. That obviously, as we often talk about, disregards reinvested dividend income, for example, and it disregards just the kind of foreign outward-looking nature of the FTSE as well. So if you want to know whether the market is undervalued or fairly valued or overvalued, those are the kind of measures that you need to be looking at as opposed to the index number itself.
And I suppose also there's that element, isn't there, Nick, where if you're buying the index in a tracker fund, then obviously you're just buying the index in a tracker fund. But if you are investing in individual companies, you need to pay attention to what they're doing.
Very much so.
I mean, we had this example with Pearson last week, didn't we? Cut its dividend, delivered some bad news, share price falls 30%. Now, to many investors, they would have looked at Pearson and gone, large international company, earns lots of money in dollars. Hey, if this trend of earning money in dollars that translates into more money in pounds and pence is on, I'd buy Pearson. But they needed to look a lot more in detail.
The British Telecom this morning, down 18%. EasyJet down 9% this morning. So it is a stock picker's market. Indeed. It really is. Two-tier market.
And speaking of which, you've got to look at some companies that I think also maybe investors a couple of years back didn't pay quite enough attention to. They looked at those dividend yields and they thought, great, those supermarkets look brilliant. And then they got hit. This
was a piece that Holly Black in the Investment Extra wrote in the Daily Mail. I've got a quick slide to take a look at. How the shops fared, market share, 2012 to today. Obviously the key ingredients here, Aldi and Lidl taking market share. Now, Holly basically wrote a piece that there was lots of interesting numbers here for me. 6 months ago, the investors basically dropped supermarket shares. They thought this is it, game over. Aldi and Lidl, obviously not listed in the UK, but they've gained market share. Profits were lost as prices were being forced lower and lower. And if you go to Aldi and Lidl, you just see that here, there and everywhere. Falling value of the pound increased the cost of production and imports. Recovering oil price increased the cost of logistics and transportation. So the major brands basically raised their prices. Then you had Amazon and the likes coming in, promising fresh groceries, delivering quickly, often same day at low prices. And then what happened, like everything else in 2016, the supermarkets reported a bumper festive trading period, going against what the view was, the forecasts were. So this basically then raised the investors' doubts whether they've actually cashed out too quickly in the sector. And they've been absolutely stunned by the Christmas recovery. There's some data from Kantar World Panel suggested consumers spent an extra 480 million at the supermarkets this Christmas. and this boosted the supermarket sales by 1.8% overall. Interesting, a typical household, how much do they spend in the lead up to Christmas?
On everything or on their food?
Basic food and
presents.
Christmas. Yeah.
Food and Christmas. Ooh, £400.
£365. That was a very good.
That was a good guess,
I
wasn't it?
clearly didn't do anywhere near it as that, but that's another
Yeah.
story. So grocery prices increased for the first time in 28 months, they've said. Tesco, Sainsbury's, Asda and Morrison, the big four, reached 72% of market share between them, so there's still big players in this sector. But just to sort of finish off on this, the big four, this is the first positive price movement since June 2014. Morrison share price, what's that climbed in the last 6 months?
Oh, in the last 6 months, I reckon that's up 30%.
33%. You've been checking my homework.
No, because when we did a Morrison story the other week, I checked how much it was up over the past year, so I knew that. So
Tesco's?
Tesco over the last 6 months, I reckon it's up by less than Morrison's, 25%.
26%. Sainsbury's? You're too good at this.
Sainsbury's, I think Sainsbury's is the interesting one because Sainsbury's, I think, was already doing was doing better than the other supermarkets. So I don't think it's risen as much. Is that correct?
That is correct. 15%.
Oh!
You've just won the lottery, sir. But the important thing, Sainsbury's boost came from the takeover of the Argos, and Morrison's had a clothing range which helped significantly. What really caught my attention, none of the supermarkets that were on the brokers' buy lists that Holly and the team basically looked at. So the brokers weren't saying buy these, and the art of contrarian thinking, if you'd gone against the views, then you would have, well, clearly if you bought these shares, you would have had a tidy 2016.
I think what's interesting about the supermarkets is that obviously there was, the story was they're basically in a structural decline. The grocery market is changing. You've got Aldi and Lidl taking their market share. Then you've got the sort of technological aspect of the Amazons and this world. But what you got was obviously a couple of those supermarkets, especially Morrison's and Tesco's, had a terrible time.
Yep.
They got new people in charge, and the new people in charge looked at it and went, "How are we going to make the shopping experience better?" They went, "Right, let's make it better for the customers." And actually, I think you're seeing that pay off, and I think that's quite encouraging.
Yeah, you're right. And of course, what we had a couple of years ago was that race for space, where they were all going for the mega stores, which abruptly came to an end. Which for the likes of Sainsbury's is pretty good news because they've got a lot of property over the country. So what they've chosen to do instead is to concentrate on online and convenience stores, and those that have stronger presences. The online bit, for example, has tended to be a bit of a weakness for Morrison's because they're a bit behind, are growing very strongly. But the other thing that's changing all the time with the supermarkets is when it stops being a grocer and starts being a retailer. If you look at M&S, for example, they've obviously got the traditional clothing range, but their food range has been doing so well for so long that that's getting larger and larger. And of course, for their part of supermarkets, most of them have got clothing ranges, let alone Argos at Sainsbury's, of course. So there's a bit of a blurry mix coming into
The last thing I'll say on this, my very dear friend, he reckons his £10 Lidl Christmas turkey was better than his £80 turkey breast at Marks and Spencer's.
How many turkeys did he have?
He had two. He's a greedy man.
On that note, we will finish this half of the show to discuss gold in the second half with Adrian Ash of BullionVault. Join us then. Goodbye. Welcome back to the Investing Show. Joining us now, we've got Adrian Ash of BullionVault to talk all things gold. Adrian, welcome to the show.
Hi, Simon.
So, last year, gold did reasonably well. Am I right in thinking?
Well, for sterling investors, it was up 32%,
Yeah.
so I'd say it was pretty good.
But if you were a dollar investor, it wasn't quite as good.
It was
So
about
there's
10%
there's a
last
sort of
year.
sterling element.
There's a
going
big
on
element
there.
of sterling in that, yeah.
So, I mean, the first question I would say, actually, to go back to basics, is why do people buy gold?
Well, gold tends to do well when other things do badly. So if you look upon it as a kind of form of financial insurance, it tends to balance out the risks that you might get from equities or bonds. Obviously, 2008, gold did spectacularly well. Sterling investor was up 40% at the same time as house prices were falling. FTSE was crashing. You had the same last year, obviously, when the pound was dumping after the Brexit vote, as you say, and gold was up 32% for the year in sterling. Now, you don't know when those kind of crises are going to hit. And the interesting thing in 2016 was obviously Brexit. Everybody said this is going to be terrible for everything. and wasn't in the longer term. Then obviously with the Trump victory, everybody said, well, gold's going to go to the moon if Trump wins. Gold rose for about 12 hours and then started to come back down again. So you can't really tell, and I think that's what's important about 2017, is you can't really tell which way to bet on this right now. So having gold as part of a broader, diversified portfolio, I think is the way to go.
So it's almost a sort of an insurance policy against things that you don't know might happen.
That's right.
The famous unknown unknowns.
Well, it's more that, I mean, in this year, I think you can actually expect the expected, because we know when the crisis events are in 2017. They're marked on the calendar, very much as the Brexit referendum was, as the US election was last year. You know, we know that there is a Dutch election in March, which could prove very volatile for the euro, because if Wilders wins, which looks as if he will, you know, he's on an anti-euro platform. We then have elections in France. Italy is going to need a new prime minister at some stage, Germany as well. And a lot of these are being seen as referenda on membership of the euro or the broader European project, same as Brexit. But as I say, we don't know which way it's going to go for the markets. So I think it is about, you know, it's that unexpectedness that people are looking to hedge with gold. BullionVault customers, I mean, our typical user holds about 10% of their investments in gold, and they see that as being kind of go to hell fund, if you like. You know, what's going to go up if everything else goes down? It doesn't always work. It's not guaranteed that gold will go up. There's nothing mechanical about it that says that gold will go up. But typically, fund managers, big money managers, private wealth in particular, will move into gold when other things are doing badly and continue to do badly.
And have you guys ever looked at what percentage of people actually hold gold? Is it still a minority of investors?
It's very much a minority sport, very much. And you know, and that's the thing. If you look at the amount of the quantity of gold there is in the world, best estimate is about 185,000 metric tons has ever been mined in history. The steel industry worldwide puts out more than that every hour. Okay.
Yeah, wasn't it meant to be 6 swimming pools worth?
Well,
something like that.
If you cast it into a single cube, it wouldn't quite cover the length of a tennis court.
Right.
Okay. So there's quite a lot of it, to be honest, you know, for what gold is used for. But it's a limited supply, and mine supply is adding about 1.5% to that per year, very steady in the bigger scheme of things. An awful lot of gold can't come back to market. It's being held as jewellery. I mean, India is, you know, the world's biggest holder. Indian households, probably about 20,000 metric tons. Central banks, of course, and they're not sellers. European central banks, the Bank of England famously, were sellers 20 years ago. But as soon as there was a financial crisis, they all stopped. So an awful lot of that gold isn't coming back to the market. So it's really about what's happening at the margins.
And that relatively low holding of gold basically presumably influences those big runs that we've seen it periodically go on. So there was the big financial crisis run, wasn't there?
Yep.
Up to over $1,900 US.
Yep.
And there was one in the 80s, wasn't there? That was the big.
It
that
ended
was
in
the big one
1980s.
before
The
that.
big one was in 1980s, starting in the early 70s, when gold had previously, of course, been locked into the financial system as the base of the US monetary system at $35 an ounce. Nixon then took the US off the gold standard in 71. Officially, it was already off, but officially took it off. January 1980, you got to a top at $850 per ounce. So yes, I mean, the 80s were a phenomenal run. But we've had a very strong run over the last 20 years. I mean, if you're a UK investor and you've held 10% of your portfolio in gold alongside, say, 60 equities, 40 in bonds, a very simple model portfolio, you would have actually done better than if you hadn't have had any gold over the last 20 years.
And presumably there's an element of added volatility now, in as much as rather than dealing in the actual physical metal, you're possibly going to be dealing in a derivative or a synthetic, even a tracker. I assume that adds to the volatility.
It certainly can do. I mean, if you look at where is the price set? I mean, in the very short term, second by second, it's very much set in the futures market, in the US COMEX exchange, where people are trading on leverage, and they're trading on what the gold price will be in 3, 6, 12 months. And of course, if the gold price is going down on a 12-month view from what's happening in the futures market, then the price for spot physical bullion right now will tend to fall. But the big difference for an investor, and this is true for a lot of hedge funds now as well, post-financial crisis, is rather than taking a synthetic position and saying, okay, I've got exposure to the gold price, they actually look at, yeah, but in the final analysis, where's my credit risk? And I think this explains why gold was such a good performer over the last 10 and 15 years, was that the financial crisis really was about credit risk. Suddenly, who's going to go bust on me? And that includes brokerages as well as banks. as well as other counterparties for big financial institutions. Gold, of course, physically owned as a tangible good, doesn't go bust on you. It's physical property. So it's a bit like real estate, it's a bit like housing, except you're off risk for mortgages, because you own it outright, you buy it in full cash price. And the other thing is it's in a very deep, liquid global market. So it's actually, you've got all these sources of demand worldwide, central banks, Hong Kong investment funds, central banks from China, Russia, investment funds all over the world, and of course household jewellery consumers in particularly China and India.
So with the obviously with this demand for physical gold, if we set aside the sort of synthetic replication for 1 minute, the physical gold demand, obviously you've got the ETFs, which a huge sort of swelling in ETF use, wasn't there, especially through that big run of gold's rising prices a few years back. But also, presumably, there's been a big uptake in people using services such as yours, such as BullionVault and other companies like that, because basically this has kind of opened up owning physical gold to a much wider audience. Presumably, if you can just go and do it quickly on your phone or on the internet, how different is that to what you would have had to have done 20 years ago?
Well, so I think that's a very important point. If you look, particularly take the UK, I think it's a great example. When BullionVault opened in 2005, besides some specialist coin and small bar retailers, the UK market was very badly served. Same was true in France. We've found a lot of our customers are based in France. Same is true in Italy, Spain. Germany had continued to have a pretty good retail coin and bar market, so they had a lot of access there. There were some bigger players in Germany. Same was true in the States as well. They had, there was always around the millennium there was a big surge in people buying gold coins ahead of Y2K. For fear that planes are going to fall out of the sky, etc., and what are we going to do for money? But certainly, yes, the ETFs were a big innovation, and as ever with a new technology or new access, deregulation if you like, that opened up investing in physical bullion. The ETFs hold physical bullion. You're not an owner of that. You're through a trust fund, so it's a little bit more complicated in terms of the legality. How do you actually, as I say, you're really just accessing the price there. The trust holds gold to make sure that it's not got any price exposure. Basically what its assets will track the price of gold because it is gold. But certainly, BullionVault now, we're caring for $2 billion worth of client gold and silver, 65,000 users worldwide. Our clients' stock of gold bullion is now larger than most central banks hold.
And how much of that do you store for them?
Well, we don't do the storage.
You don't do the storage?
We don't do the storage because, we're effectively an IT business.
Yeah.
And that's what BullionVault brought to this, is we bring an IT overlay that enables you to use your phone, your smartphone, or to log on from home, and to basically access large bar gold bullion. So this is the bullion which is centred in London. London is still the centre of the world's gold market, even though we have zero gold demand, really, in the bigger scheme of things, no mine production, and no refining to speak of. London is still the centre of where the world parks gold on its way from the refinery to end users. So what we enable people to do is to access that market in large bars. These are Italian job, Goldfinger size bars, okay? 12.5 kilos, 400 ounces. Now the problem that you had previously was even if you could afford a whole bar, which is going to cost you...
Not a lot of people can afford a whole bar.
Not a great deal of us can afford that, but you're going to need £400,000 right now to buy a large bar. Yeah. But even if you could do that, the vaults, the specialist vaults, because alongside the special specifications for these bars, and they're made by a very small group of refiners who are closely monitored to make sure that their bars are good and the fineness is up to spec. You then need proper vaults to care for this stuff. And
not
the
kind of thing you want to be keeping in the cupboard at home.
Stuff at home. There's various reasons around that as well. Further to insurance is one. These vaults are so secure that the insurance cost, the actuaries judge the insurance risk to be so small that you can maintain a holding inside a secure vault at a very, very low cost because they're deemed to be so safe, fully insured. So it's really about opening up access to that wholesale market. And if you compare that to coins and small bars, if you think about the smaller a unit gets, these large bars are the wholesale market. This is how gold moves around the world to become coin, to become jewellery, to become bonding wire in an iPhone. Every time you want a smaller unit, a little coin or a small bar, and you want to buy that through a shop or have it delivered online from somebody through the post, you're adding all of these costs: fabrication cost, shipping costs, extra insurance costs, extra personnel costs, labour costs. So to access the very best prices, the kind of prices that you see quoted in the paper or quoted online, for this is what the price of gold is, going to that market, accessing those whole bars. And what BullionVault enables you to do, because of the IT, is down to 1 gram at a time.
Mm-hmm. Mm-hmm. And, I mean, going back just quickly to the price, obviously, which tends to be the thing that always excites people about gold, so we have to go back to it. It's, in dollar terms, it's down about a third, isn't it, on that peak?
Yes. Yeah.
And that was 5-6 years ago now,
That
wasn't
was
it?
in September 2011. So if you remember, you had
yeah.
the US debt downgrade,
Yeah.
you had the Eurozone crisis was really kicking up, you had English towns in flames.
Yeah.
Kind of a perfect storm, if you like,
Yeah.
for people saying, heavens, I might need some gold.
I mean, do you think that we're going to go back towards that at some point, or do you think it will take a long time? Because obviously with gold, it is an insurance, it is a long-term store of value, but you do, as an investor, I guess, have to be willing to spend a lot of time sat in the doldrums.
Absolutely. And the thing with gold is, you've got to understand, I think, somebody who takes a position in gold and just buys all gold is obviously going to miss out on everything else that they would ordinarily make in equities, bonds, real estate. If you view it as an insurance policy, you really need something to insure. So just taking a position in gold only, or silver, is going to expose you to just the ebb and flow within that particular precious metal. So certainly, I mean, where have we come from? We had a big low at the end of 2015 in gold, $1,045 per ounce. Interestingly, that was a level at which the Reserve Bank of India had bought a big chunk of gold from the International Monetary Fund back in 2009, when gold was on its way up. So if anybody knows anything about gold prices, you might imagine it's the Reserve Bank of India. So 1045 was the low back in late 2015. Early 2016, we had a very sharp upturn. I think there are a couple of factors there. The US Fed didn't follow through on its first interest rate hike, disappointing markets about actually we're not going to get a better yield on cash or bonds anytime soon. That raised a question really about whether central bankers are in charge. So as I say, gold tends to do well when other things do badly. It does best when people lose confidence in central bankers, governments, the authorities keeping a lid on things and keeping everything running smoothly.
It's interesting because traditionally, of course, it had an inverse relationship with the US dollar, which is what a lot of portfolios used to be based on. But that's broken down now to a certain extent, that relationship, because both gold and the US dollar are seen as these haven assets.
Yes.
And when you've got markets such as in the UK, sort of risk on one day, risk off the day after, you can imagine that those are you see the movements of monies in those directions.
And of course you get a double whammy as a sterling investor. If the gold price is rising in dollar terms and the dollar is rising, then of course, and that's what we saw, you say, Simon, in 2016.
Adrian, that's all we've got time for. Thank you very much. Very informative.
Welcome.
Richard, thank you very much.
Simon.
And thank you very much for watching. Join us next time on The Investing Show. Goodbye.